If I'm low on time, let's get started. So guys, thank you all for joining in. I want to have a chat on the limitations of financial independence, which there are many of, and having a quick crash course with you all, which I think is a nice follow-up from Jess's team, where we just really went into depth into the stock market and the emotional aspects of it. And I hope to come up with a lot of practical advice that will help you with it. Just up front, Dave has already mentioned it, but I'm not a financial advisor. None of this is financial advice. Please do your own due diligence, and not just for my sake, but also for your own sake, because yeah, if something goes wrong, it's better to know why it went wrong and avoid it next time. So quick bit about me, 29 years old, originally from the Netherlands, technically living in Scotland, but right now in Germany, close to the Swiss border. I work in IT, and I've got a very wide range of random side hustles along the lines of I've done the Deliveroo's with Deliveroo, beer money, crypto, and everything along these lines. Also very big into travel hacking, credit cards, and a lot of these little things that drive a lot of people nuts. But enough about those bits about me. Let's get going. So today I want to cover, well, first of all, just going back to the basics. Financial independence, what are we actually talking about? How do you calculate it? What does it come with? What do you need to accomplish it with? Because Jess has given us some amazing stats, but we also need actual practical means, the tools, the investment vehicles to get there. And that comes everything but understanding the calculations, knowing how to pick the right broker, the right instruments to use for investing purposes, and obviously ETFs, how you judge them, whatnot. And also just have a good general chat on what financial independence is about, what it can mean for you, and what it shouldn't mean. And then hopefully I will be able to do this quickly, and we have a bit of time left for questions in the end. So let's get started. This is a quote I always really love from Charlie Munger. The first rule of compounding is never interrupt it unnecessarily. If one can find a high-quality business that can compound its earnings over time, a holding period of forever removes the temptation to sell and lock in short-term profits, potentially foregoing a much larger investment profit over time. AKA, the biggest enemy of our investment returns are we ourselves. Once we got everything set up and going, it's even for me, I've had so many times where I have basically screwed up my strategy or made a little admin mistake that's ended up costing quite a bit of money. It's keeping it simple and straightforward is really key in keeping the compounding running. So just a quick bit about me. And maybe I can, function as an example of why do you want to get to financial independence and why not. So for me, financial independence has always really been about, let's quickly check. There we go. That was just a message from Dave. It's always been about having options and being able to in control myself. So I think for many of us, we will have an employer that will demand certain things from us. And if you got a nice stack of cash sitting in the bank, or you are financially independent and have the means to say, I'm not interested to certain duties, or I want XYZ, I want to be able to work from home. Financial independence gives you that ability just in a working phase to already say that, and to do things on your own terms, which is for me always been the motivating reason of I don't want to be stuck in an office for the next 50 years. And I think that's just simply not good for any human beings. And if there's any magic trick called financial independence to get out of there, we should follow it with all the passion we can have. So let's keep going. So how did I actually get started myself? Well, to be honest, I've always been into financial independence, trying to make more money again and again as a kid, which sometimes difficult, because if you think about that, we're trying to do something most people can't do or not willing to do. We're going against the curve, and that leads to resistance. So for me, it's very good to find a similarly thinking crowd here in these presentations, but also to think about, where are we all coming from? Like, I grew up relatively and work myself up to what I got at the moment. But the reason I'm able to do that is because of where I came from, of what I understand money-wise, and also simply of what I know what financial independence can do in terms of giving you back your self-control. So in terms of journey, now I'm a good bit on the way to financial independence, but I also just have a normal job and not that crazy high of a salary and many years to go. But that is not that important in terms of, if you have a crazy high paying tech job. What's way more important are what you actually invested in, what you can control in that. So one thing, I think we should ask ourselves, like, are we actually working more than we should? So for example, I could easily pay my cost of living by working a day a week, and just live off that. But then my life would be quite boring. I couldn't do any of the extra things, but I could do it. I could just work one day a week and be done with it. And some days I'm like, that would actually not be a bad idea. But what I mean by it mainly is, if you look at your own life at the moment, you're already working 5 days a week. Instead of trying to get to financial independence as quick as possible to save the most possible, it's also worth just wondering, do I want to work a day less instead of trying to get more and more and more? And this one is one I always like: are you spending less than you should? So I often end up in the mistake that I'm way too frugal and I don't spend enough. Sometimes you should actually spend more to gain this extra bit of life quality and to find basically it's what you're comfortable with spending less. And discovering that is a journey. Took me, I started out probably at €400 a month spending as a student, living in a relatively crappy student room. It's taken me years to get up to like £800, like €900 a month spending wise. To many of you, that might sound insane, but for me, it's generally a struggle to spend more and to find ways to spend it. But I just think it's important to sometimes ask yourself the question, maybe we're missing something. So, and lastly, I think this kind of matches up. What kind of spending matters? Is it going for dinner with your family the bit that matters, or is buying the newest game the bit you care most about? One way I always really like describing it, say you want to buy something, then buy it straight away, throw it in your Amazon wish list, come back a week later. If you still want it, buy it. And if we're talking about like little small amounts, just do it. Don't think about that. And I'm also talking to myself now, like, keep that in mind, actually buy the things you want. So guys, also to get started with question time. And this is actually one I really like. What is the last money mistake you've made? And also maybe why? Everybody fire something in the chat. It can be very short, along the lines of, bought a very fancy car on finance. Sure. Anything along these lines, fire it in the chat and let me know. And in the meantime, I'll let you guys know what my largest mistake was, at least for the last month, which was actually a really silly one and kind of also nicely matches with the Charlie Munger quote. So in my case, it was actually leaving cash sitting idle when I switched between two brokers. So I was moving from a broker to a new broker. Oh, sorry, Alan. Is it just for you that the sound is not well? Dave, can you hear me fine?
Yeah, I've got you. I've got you coming through fine here. Same when Frank said, so I suppose maybe it's a different connection, but I've got you loud and clear, buddy.
Okay, fine. Hope it works out, Alan. Anyway, a pretty expensive mistake. So I thought, I was switching between brokers and cashed out my investments and set them up to be automatically transferred over to my new broker and be invested. But that didn't work out. And that money sat there for weeks and weeks and weeks in a row. I think, as we've all known, the last weeks have been very volatile stock market wise. So I had to purchase the same investments back very, very expensively, which in the end basically cost me £2,000 because I didn't check, because I just trusted the automation too much, and because I didn't stay on top of it, which is a tricky one. And believe me, I blame myself for it, but still, it's not something you can avoid. It happens. But yeah, I've made larger, more expensive mistakes in the past too, but yeah, those were in magnitude of sometimes 10,000 plus. That hurt a lot more than 2,000, but still, it happens. And one phrase, I'm not the biggest fan of Dave Ramsey, but he always uses, he basically calls it the stupid tax. Yeah, no, I consider this a stupid tax for me to learn to check my transfers a bit better and not just trust the companies do it for me. So guys, let's get going now with a bit more detail. And in terms of financial independence calculation, so this is just quickly bringing up my budget, what I spend monthly. Everybody will have something else, but this is just for calculation purposes, so we can get a fire calculation going. So as you can see here, the monthly amount I'm spending is 843.50. That's in pounds, so call it €900 monthly. Basically my core spending, and I think everybody should have a sheet like this where you just basically see, okay, these are my minimal expenses, and these are kind of like the extra expenses, the things I just like to do, but are not necessarily needed to keep life going. So one thing I also want to add in, but we're all actually going there. Let's talk about the FI journey in numbers. So how do you actually get to financial independence? Actually, I'm just going to bring them up all at once because this is just easier. So, what are you actually able to save each year? Like, how much do you earn? How much do you spend? What is left after the fact? What is the absolute amount you can save up? What are you spending? I think that's clear enough. The current amount you've got. What are we expecting future performance-wise? Expected inflation levels, which right now is actually obviously a lot harder to forecast. The 2-3% we had on average, we can't really count on anymore, or well, at least not for the next year. We'll leave that judgment call to people with a bit more knowledge on it. And your withdrawal rate, what are you comfortable with once you've got everything invested? But we're not gonna just guess about this. Let's jump out of the presentation and let's go and have a look at this calculator over here. So I've taken this calculator, which is one of the simpler ones, but it really does the job nicely. And let's see how long it's going to take me to get to financial independence, presuming I'm starting from scratch. So first of all, this is just this 10,122 is simply my monthly costs multiplied by 12. And in terms of income, what shall we say? What is a good average income in Europe? Let's call it 35K. I think that matches nicely. Although I hope in Ireland that the cost of living is quite a bit higher. Yeah. Oh, and AOV fair shout. Actually, I live in. Those expenses are in one of the most expensive cities in the UK, in Edinburgh. So it might sound unrealistic, but yeah. It's unfortunately, yeah. So the 900 a month is in Edinburgh, the 400 we're talking back in the Netherlands, but that was as a student living in a small student room and having healthcare covered by the government, hence I could live that cheaply. And I've got a partner too, so living costs are split in that sense. So that's indeed a fresh shout, should add that in there. And I know that Irish living costs are incomparable to a lot of the rest of Europe and are way more expensive, and you need triple the amount to get to same living standards often. I know. So in that case, let's bump up the salary a little bit, because let's hope that everybody who does this has a 50K or something along these lines average Irish salary. So taking this, and presuming a 4% safe withdrawal rate and a 5% return on investments. So it's actually good to clarify with that it's after inflation. So if on average the market would earn 7%, take inflation of 2, that would be 5. But with the inflation of now, we would be looking at very different numbers. So if we follow this, it would take me 5.6 years to get to financial independence, and with roughly a total pot of, we can call it 230-ish as the total amount that needs to be saved. And the funny bit about this is obviously just me and my personal expenses. I don't have kids. This excludes my partner. And if you think about it, if you would involve a family, with this and a house you gotta pay for an elderly parent potentially to take care, you can multiply this number manyfold. And right now I'm working more on a 700,000 to 800,000 euro number for myself personally right now with partner. That's a far more realistic number based on my expenses right now. And if you really want to go cheap, it does work, at least according to the calculators. So given I only have 7 minutes left, I'm going to speed up a little bit and we're going to skip these out. And I want to go for the more practical. So Dave, I'm working roughly toward 800,000 euro is what I'm aiming at the moment, because that's what I'm expecting to be needed. And it might go up, it might go down. I started at 300,000. That's my initial number even, but yeah, I think it's good to keep the number flexible, because if you just pinpoint and say, oh, I'm going to save X, Y, Z, it's just important to here we're going. But guys, let's actually get to the practical things, because I really want to share those, because I think they're at the most value for others in the end. So let's presume for a second you understand financial independence. You've got your budget, you've got everything calculated. You'll need a broker to buy products to actually invest in. And picking your broker in the end, if you're going to keep them for 20 years, it's one of the only factors you can really control in terms of cost, in terms of making your journey faster and hopefully a bit cheaper. So just a few obvious bits to start. How much do you pay per trade? That sounds silly, but many brokers will charge per exchange or per product at very different prices. Companies like the Giro and Trading to 12 in Europe are good examples of one that are very cheap, only charge €1 or €2, and are worth going for. Can I buy the right ETFs? We'll get to that in a moment, but some brokers will just simply not offer the products we're after for financial independence purposes. What is the bid-ask spread? So basically, if you like some brokers, their left prices might be slightly different than others, and the spread between what is being offered and what is being paid for might be a lot larger. Trading to 12 is a good example of that. It's very worth just checking a couple of them. Hey, are you having a 1% bid ask spread? Is it just a couple cents? Just to keep in mind, it can be one of these little costs. If you buy every month, it is not much, but over the years it will add up. Does the broker process the transactions themselves or outsource? So many brokers nowadays, they actually outsource to other companies. And yeah, it will never lead to the cheapest, most efficient transactions for you in the market if that's the case, against the broker just doing it themselves, like many of the larger ones do. And actually, do they actually offer a W-8BN form? So that's meant to get you a US dividend tax back. If they don't offer it and you got to do it yourself manually, it's pain. And in the end, 15% dividend tax out of the total dividend you're getting paid out, being able to get it back makes a relatively large difference in performance. In the end, platform charge, I think, is obvious. FX is basically about if my main currency is euros and I'm buying something in pounds, what are the costs of transferring it out? And the exit fees, are they going to charge you if you want to leave them? I personally find it really annoying. If I want to leave them, it should be free, but hey, it's me. Any sign-up bonuses? I believe Dave has a good link later where there's a sign-up bonus for the Giro, but it's just worth checking. If you join a broker, is there anything they're offering? Very often I'll get 50-ish without any issues, just by signing up and moving my business over to a broker. And if you're moving, you might as well get a bit of bonus at the same time. These are just some other minor charges to have a look at. Dividend charges, some broker charge, admin fees, connection costs. This is one in particular for the Giro. Every exchange you invest on, they'll charge you $250 per year, which is quite annoying. But these are just like, consider the practical checklist to go through, even from your broker. Check it. If they're not offering you the best deal, leave, because cost is one of the only things you can actually control on your investment journey, together with what you actually obviously buy, of course, and you yourself sticking to the journey. So regarding ETFs, and I'm going to presume everybody knows what an exchange traded fund is, as a basket of stocks where basically the whole world is covered in. If not, please fire it in the chat and I can give a brief explanation. But this, I think, might be relatively useful for many people. So many people within the FIRE community always talk about VWRL or VWCE, which are basically funds that cover the entire market at once, are very useful and are very cheap. They charge 22 basis points, which, if you look at it years ago, is very cheap, and we should be happy with them. But there's a better way to go. At least I can't comment on the Irish context, but I'm commenting just in general if we're talking about lowering costs as much as possible. So I used to hold VWCE, but I've actually switched over to another Vanguard or two other Vanguard funds, where basically you're buying a little bit of the emerging market and the developed market, and it creates the same exposure. I've deemed the disposal on ETFs, which is a bit skill. Yep. So anyway, it's slightly cheaper than VWCE, and actually want to show what it does if we're looking, on the long run performance-wise. What did I have this one? No, it's this one. So this is actually a really nice backtesting page. And by backtesting, I mean just testing a certain investment portfolio. Backtest at curvo.eu. Website we're checking out, but what I've done here is basically created two portfolios. One called VFEM VEV. This is what I am currently invested in, and VWRP, which is the old fund I was in, and it's just accumulating version of VWRL. And the chart here is interesting because it's going to show this little cost difference of 8 to 9 basis points between the two. And what is actually going to matter on €10,000 investment starting from 2005 investment wise. So if we just basically jump to the end and do the results we care about, that if you look at the amount, we're only talking €1,400 on the €10,000 investment across the whole board, but that is 10,000 you've invested in, €1,400 difference just by very minimal cost differences, which is a very minor effort for many to switch over to, and obviously check your own legislation. And if your country is better for accumulating funds, then obviously go for that. But yeah, just make sure you're getting the best deal out there. And Dave, I am, I know I'm roughly out of time. Do I still have a couple minutes, or do I have to call it quits?
Yeah, it's 7:20, but go ahead, and if you can take a question too, that would be great. Huh?
Sure. Now, let's call it quits then. And unfortunately, I can't finish the whole presentation, but yeah, I hope this was at least of some values. Are you
going to stay on afterwards, Alvar?
I'll stay on, yes.
Cool. So take another minute or two, and we'll do a question, and then we'll try and keep on schedule anyway.
Perfect. I just wanted to really get these practical things out of the way, because I think running your broker by this checklist and checking the ETFs you're buying, and not just assuming that the standard Vanguard funds are the cheapest, or one of the only things you can control, and it will save you thousands on the long run if you stick to it. And a couple criteria more on ETFs here, but I'm actually gonna jump by here because that's the last thing I really want to cover is quickly the 4% rule. So I'm going to presume everybody is familiar with the 4% rule, the Trinity study, the whole principle of that you can withdraw 4% out of a portfolio, and then it will remain at the same value again and again and again, and you can live off that until eternity. That's the basic principle of it. Although when I did the calculations, it was based on a 30-day retirement or 30-year. When I did this study in the 90s, but since then there's a guy called PoorSwiss.com. He's done the same calculations and actually concluded that the Trinity study still applied. You can still withdraw 4%, and your portfolio should not run out of money, and you can happily retire. But a few bits, I think we're not adding in, and probably very important one from Ireland, which are ETF taxes. None of this is taking taxation into consideration. So if you got to pay 40% tax or 41, it was after 8 years out of on your ETFs every single time, that will obviously take a massive hit, and you'll have to have a far higher safe withdrawal rate to get this to, or lower to get this to properly work. It doesn't cover the investment cost, we obviously went broker cost earlier, but if you're with one of the legacy brokers and paying €20 a trade, it's not covering that. You'll need to have even a lower withdrawal rate to cover that. Sequence of return risk isn't taken into account, which is basically the moment you retire, everything goes wrong. You've got the biggest market crash ever allowed 2008. It doesn't necessarily guarantee for that. It assumes 2 to 3% inflation. Well, we got 7 right now, or probably even higher. Also doesn't work together, and the bond yields. Back then, bond yields were far and far higher, and with the 0 to 1% we're having now, which are basically useless. You can't safely rely on that. So it's just important to take those caveats into account and potentially lower your safe withdrawal rate, or have other sources of income outside your investment portfolio as a rental property or a pension or a own business to complement them. Although I still think, out of all the investments vehicles you can use, I consider it reliable, and I'm putting my money where my mouth is, and I'm gonna rely on this. But I can imagine that not everybody is exactly comfortable with that. Cool, guys. I hope that was of value. I can take a couple questions, and I think people want to take a break after. Any? Go for it, Dave.
Yeah, I was going to say, just looking for the chat here, there was obviously Aoife mentioned that I suppose it's important to say what country you live in. There's expenses, you mentioned that already, are 100% or shared for Irish standards. I think you mentioned you responded to that, didn't you? Okay, there.
Yep. No, so I think I already covered that, and Megan made a good comment. Yeah, regardless of what you do, that's in open markets will involve the accounting fees, keeping track of the ETFs and purchases. Absolutely. That doesn't change. You can only optimize so much, but it's still got to be done.
Perfect. There was a question as well here, or even a comment in terms of the ETFs from the taxation point of view in Ireland, for people who are logged in from Ireland. There's an 8-year deemed disposal, but I think when you look at the calculations that you punched in with your own numbers, the idea here, Alvar, I suppose, is that everyone's got a different situation, no matter where they live, what they invest in, and we can really change all that. What was the guide that you used for the calculations? Oh,
sure. The calculator was this one over here. Networkify.com. I can share the link later. And the website for the backtesting was Curvio, or sorry, backtestcurvo.eu. I can share one later too. They've got a lot of free-loaded portfolios in there. The website is built by a guy that's very much into FI, so I think for many people this one would be useful.
Yeah, perfect. When you asked for the biggest mistakes in relation to time, Craig mentioned that he sold 2 European ETFs to consolidate to one, but was on vaccination announcement day. He set the limit on I'd set the limit on the buy. Market spiked and I was left in cash, so he had to buy back, but it was more expensive.
Yep.
And Vince said that his biggest mistake was not paying off his credit card debt immediately. It cost him a lot of interest payments.
And on the switching you started 10 years ago count as a mistake. Nah, I'm not counting that as a mistake. You're here now.
Yeah. All right, perfect. So look, what we'll do is we'll put the questions together and we'll take it afterwards informally, Alvar. But look, that's fantastic. The reason I like putting you up first on the presentation, like originally, is you're like a battering ram and you come in with all the information that we need to hear from the investing side of things for people in the stock market. And you're really, you know your stuff, like they can see that. And I know that if you wanted to do a presentation options today, and I think we'll get you back to specialize in that area. You've got a wealth of knowledge. So listen, thanks so much for coming on and actually presenting again, Alvar.
Thank you, Dave. Pleasure to be here again.
Perfect. Okay, brilliant, guys. So look, we should have, let's see, we'll go for a break around 8 o'clock. I'll put a bit of bit of buffering to that in case any of them went over. And next up, we'll actually have Megan. Megan is from, let's just reclaim host from you there now before we do an intro. So let's have a look here, guys. We have Alvar. Let's reclaim host. Stop sharing screen. Perfect. Okay, so I see a few more people have joined. That's fantastic. Welcome, welcome. Megan is up next. Mrs. Money Hacker. Megan, you on the call?
I am indeed. Can you hear me?
We can hear you, yeah. Good evening. And do you think you'd be able to manage the webcam?
I'll try it. I'll give it a go. We'll see if it holds out.
Perfect. Great stuff. So look, I'll do the introduction. Megan doesn't need much of an introduction. Delighted to have you on, Megan, from Mrs. Money Hacker. Megan's buzzword this evening, guys, is mental health. It's actually quite a big buzzword anyway, funny enough, and probably a serious topic. Megan was at probably, I think, the very first live I originally did. It's Fire HQ, now Fire Dave Live, and I've stayed in contact with you, Megan, since day one. In between events, Megan has a wealth of knowledge and is extremely helpful, helped me with a few questions many a time, and unfortunately experienced the common burnout that we hear about. That's another buzzword, but it's a real thing, whether in fire or anywhere out there at the moment. And I suppose Megan will help us learn from her experience, tips to avoid burnout in life, managing our health, families, finances, sleeps, jobs, inflation, cost of living, housing markets, mindset demands, all those general things that we experience in life. And we can get set on these goals and it can interrupt other things. So it's amazing to have a purpose, I think, like fire. And I think we're quite similar in our own personalities, me and Megan. And I think once you then manage to manage yourself properly, and I think Megan will talk about that, and avoid these self-sabotaging behaviors. This can be outside of fire, this could be a health, could be a sleep, whatever, that don't serve our overall well-being. And a lot of us get into fire to really design life by design, to live life by design. So